hey, the price of gold keeps going up. And now it's at an all-time record high. It just blew through 3,000. Are you worried about that, Chair Powell? Are you worried that the gold market is saying something that maybe you've got your policy wrong? During the Q&A, and I'm going to get into a lot of that. But one question that nobody asked, which should have been, asked by everybody, was the price of gold. Nobody said to Powell, hey, what do you think about $3,000 gold? Because on Monday, gold closed above 3,000 for the first time ever. It closed above 3,000 again on Tuesday. And again, today, it hit another record high. It closed at 3,048. And it's up again the evening, another $5. So as I'm recording this podcast live on Wednesday evening here in New York, or I'm not in New York, but New York time, gold is trading in the spot market at $3,053.30, up $5. Nobody brought this up because gold is flashing a warning that the Fed is too loose. In the Q&A, one of the reporters brought up Alan Greenspan's old definition of price stability, where Greenspan said, well, price stability is where businesses and workers don't even bother to calculate price changes into their plans because prices are going up so slowly that nobody really cares, right? So it's like indifferent in decision making. And he asked Jerome Powell if he would, ascribe to that definition and if he believes that we have price stability. And he did say, yes, I like that definition. But he really didn't answer as to whether or not he thought we had price stability, kind of dodged that. But the point I'm making in bringing it up is that Alan Greenspan also talked about the importance of gold in setting monetary policy. Alan Greenspan said that even though we're not officially on a gold standard, he said that he used the gold price as a reference, as a signal to let him know whether monetary policy was too tight or too easy. What Greenspan said was that if gold gets up to $400 an ounce, that means that he's too loose. If it goes below 300, that means he's too tight. So obviously at the time that Greenspan made the statement, gold was probably around $350 an ounce. And he kind of looked at, if it was going above 400, I'm too loose. Maybe we got to tighten policy. But if the price of gold drops below 300, maybe we're too tight, right? We got to ease up. Well, of course, gold's 3,000 now, right? So that shows you how much things have changed. I looked again at the chart going back to the beginning of this century. The S&P is actually down 60% if you price it in gold. I mean, that is an enormous bear market. And it really shows you that the entirety of the gain in the stock market is due to inflation. It's due to the destruction of the value of money, not a real increase in the value of the companies that are represented by the S&P 500, but that we are, measuring their value in rapidly depreciating currency. And it's not just the dollar relative to the euro or the yen or the pound, because all those currencies have gone down. And so it's a global inflation. It's not just an inflation in the United States. But Greenspan acknowledged that gold was an important market signal. And he even said, we're not officially on a gold standard, but it's kind of like we are because I'm using gold, right? So if gold goes up, I'm going to tighten, right? And so it's kind of like a gold standard, but it's not a gold standard. Well, what about now? What is $3,000 gold saying about Fed monetary policy? Well, apparently nobody cares. Nobody even wants to ask these questions. Not one reporter in that room. There was a reporter who asked Powell about the stock market and its decline, and if the decline in the stock market concerned him at all. Are you concerned about that, right? Are you concerned that the markets are repudiating your policies, that the markets are telling you that interest rates are too low and that inflation is going to be too high. Nobody is even asking Powell, his opinion on that. I mean, I would love to hear his answer, although I'm sure, he'd find a way of weaseling out of it like he does for any question that he, either can't answer or is uncomfortable answering. But that is the reality. That is the real proof that the Fed is wrong, because you have a market that is saying that the Fed is too loose and that these rate cuts are a mistake whenever they come. The Fed should be hiking interest rates, not deciding when to cut them.
No longer purchase forward contracts. You can't purchase futures contracts from New York on the LBMA. And so it's drying up the liquidity in London, where they would use, a lot of the banks would hedge their positions in London with forward contracts, derivatives, paper. Remember, in London right now, there's 200, roughly, last week, I don't know, it's probably a little less now, but 279 million ounces of gold in London. Only 36 of that is available for delivery. The rest belongs to ETFs in the Bank of England. And that's standing behind 380 million ounces in outstanding spot contracts, 11 times nearly the number of contracts issued versus the amount of gold issued. And in silver, it's very similar. Roughly 270 million ounces of silver is all that's available of the 800 million. Now it's under 800 million, like 770, 780, because we saw 85 to 90 million ounces. That's what COMEX is on track for, to be delivered for March, of silver come into COMEX, almost all of it coming from the LBMA. And so and when you talk about 290 million ounces and there's available, yet they're trading 2.9 billion ounces of silver, again, 10 times the number of contracts standing behind or the metal standing behind those contracts, 10 times the number of contracts. To me, what it really speaks of is the lack of trust in the LBMA system, that no one trusts that they'll be able to deliver anymore. And they're trying to tell us that it's a logistics thing. It's a lack of trucks and a lack of manpower. I think they're realizing that the exchanges are being bled dry. And maybe now what we see is COMEX trying to distance themselves from the LBMA. In the last 3 months, 128.5 million ounces of silver have been withdrawn from London. And so you're talking almost 50% of the float gone in the last 3 months in silver. So between the amount of silver and gold delivered, not to mention all of the others that are standing for delivery, but they're being told it's 8 weeks, it seems like they're turning up the heat. And maybe, just maybe, that rumor of Trump trying to stick it to the Bank of England is really true, after all, because this is a very provocative move. And I think, it really does speak of the LBMA losing confidence globally in its ability to deliver. And this is the beginning. So I guess we'll see what the real reason is. Much like most of the things we've seen lately on the LBMA and COMEX, we can assume and surmise what the real agenda is. Mainstream would tell you that's not the case. I don't believe it. I actually feel that we are witnessing a shift from this paper market that all of us thought would never be broken into other hubs like Shanghai, like Moscow, like Dubai. These are cash and carry exchanges where the price setting is far more realistic, instead of a futures market where it's 90% paper and 10% physical. And no one ever stood for delivery. And you and I have been talking about this, and the logarithmic decay, little by little by little by little, and then bang. Are we at that point? Well, it sure feels that way when almost half of the available silver has been drained. And now they're saying it's logistics. We can't really get it over to you as fast as we would like. Demand for physical gold and silver is rising. And this is a move away from the Western markets. It's a big deal. We'll see how big it is. But yeah, I think this is something people really need to pay attention to, on top of the fact that it just continues to move higher. It seems almost every day now.